Question 1. Stakeholder feedback indicates a growing client demand for sophisticated tax planning strategies that aim to significantly reduce their overall tax liability. A client has presented a complex proposed transaction structure that, on its face, appears to achieve a substantial tax deferral. However, the structure relies on a novel interpretation of a specific tax provision that has not been widely tested or clarified by tax authorities. Which of the following approaches best reflects professional best practice in advising this client? Option A. Advise the client that the proposed structure is acceptable as long as it is documented thoroughly, as the onus is on the tax authorities to challenge it if they disagree with the interpretation. Option B. Advise the client that the proposed structure is aggressive and carries a high risk of challenge by tax authorities, recommending a more conservative, well-established tax planning strategy that aligns with current interpretations of the law, even if it results in a lower immediate tax saving. Option C. Recommend the proposed structure to the client, highlighting its potential to achieve significant tax deferral, and suggest that the client independently seek legal counsel to validate the interpretation of the tax provision. Option D. Proceed with advising the client on the proposed structure, emphasizing the potential tax savings, and assuring them that the interpretation is legally sound based on the wording of the provision, without further independent verification or risk assessment. The correct answer is B. Advise the client that the proposed structure is aggressive and carries a high risk of challenge by tax authorities, recommending a more conservative, well-established tax planning strategy that aligns with current interpretations of the law, even if it results in a lower immediate tax saving. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's desire for aggressive tax minimization and the fiduciary duty of an advisor to ensure compliance with tax laws and ethical standards. The advisor must navigate the fine line between legitimate tax planning and potentially abusive tax avoidance schemes. Careful judgment is required to assess the substance of transactions and their alignment with legislative intent, rather than merely their superficial form. The correct approach represents best professional practice because it prioritizes adherence to tax legislation and regulatory guidance. It involves a thorough understanding of the relevant tax laws, including their spirit and intent, and applying them to the client's specific circumstances. This approach ensures that any tax planning strategies are robust, defensible, and do not expose the client to undue risk of penalties or legal repercussions. It aligns with the ethical obligation to act with integrity and competence, providing advice that is both effective and lawful. This is particularly critical in the context of Berkshire Hathaway's commitment to ethical business practices and regulatory compliance. An incorrect approach that focuses solely on the client's stated objective without independent verification of tax law compliance would be professionally unacceptable. This could lead to the recommendation of schemes that, while appearing to achieve the client's goal, are in fact non-compliant with tax regulations. Such a failure would violate the advisor's duty of care and could result in significant penalties for the client and reputational damage for the advisor and the firm. Another incorrect approach that involves aggressive interpretation of tax law without considering the potential for challenge by tax authorities risks misrepresenting the legality of the proposed strategy. This demonstrates a lack of due diligence and an abdication of the responsibility to provide sound, risk-assessed advice. Professionals should employ a decision-making framework that begins with a clear understanding of the client's objectives. This is followed by a comprehensive review of all applicable laws, regulations, and relevant guidance. The advisor must then critically evaluate potential strategies against these legal and regulatory frameworks, considering the substance of transactions and the potential for challenge. Seeking expert opinions or consulting with tax authorities when in doubt is also a crucial step. The ultimate decision should be based on a balanced assessment of the client's goals, the legal and ethical landscape, and the associated risks. Question 2. Cost-benefit analysis shows that a proposed acquisition of a smaller, distressed competitor could significantly increase market share and generate substantial immediate profits. However, due diligence has revealed potential accounting irregularities in the target company's financial statements that, if not fully investigated and rectified, could lead to future regulatory scrutiny and penalties under U.S. securities laws. The acquiring company's management is eager to close the deal quickly to capitalize on the current market opportunity, Which of the following represents the most prudent and professionally responsible course of action? Option A. Halt the acquisition process until a thorough, independent forensic accounting investigation is completed to fully understand the extent and implications of the irregularities and ensure full compliance with SEC regulations. Option B. Inform the target company's management of the irregularities and allow them to rectify the issues independently before proceeding with the acquisition. Option C. Negotiate a lower purchase price to account for the potential risk of accounting irregularities and proceed with the acquisition with a disclaimer of liability. Option D. Proceed with the acquisition immediately, assuming the accounting irregularities are minor and will be resolved post-acquisition to secure the market advantage. The correct answer is D. Proceed with the acquisition immediately, assuming the accounting irregularities are minor and will be resolved post-acquisition to secure the market advantage. Explanation. This scenario is professionally challenging because it requires an individual to balance the potential financial benefits of a strategic decision against its inherent risks and regulatory implications. The Berkshire Hathaway hiring assessment test, particularly in areas related to investment and financial analysis, often presents situations where immediate gains might conflict with long-term stability, ethical conduct, or compliance with established financial regulations. Careful judgment is required to navigate these competing interests. The correct approach represents best professional practice because it prioritizes a comprehensive understanding of all relevant factors, including regulatory compliance, ethical considerations, and the long-term impact on the company's reputation and financial health over short-term profit maximization. This aligns with the principles of responsible corporate governance and fiduciary duty, which are paramount in the financial services industry. Adhering to regulatory frameworks, such as those overseen by the Securities and Exchange Commission, SEC, in the U.S., ensures that all actions are legal, transparent, and protect investor interests. An incorrect approach that focuses solely on maximizing immediate returns without adequately assessing regulatory compliance risks is professionally unacceptable. This could lead to violations of securities laws, fines, reputational damage, and potential legal action. For instance, overlooking disclosure requirements or engaging in practices that could be construed as market manipulation, even if seemingly profitable in the short term, would constitute a significant regulatory and ethical failure. Another incorrect approach might involve prioritizing personal gain or the interests of a select few over the broader interests of the company and its stakeholders, which violates fundamental ethical principles and fiduciary responsibilities. Such actions can erode trust and lead to severe consequences. Professionals should employ a decision-making framework that begins with a thorough understanding of the objective and the potential outcomes. This involves identifying all relevant stakeholders, assessing potential risks and rewards, and critically evaluating the decision against applicable laws, regulations, and ethical codes. A structured approach, including seeking advice from legal and compliance departments when necessary, ensures that decisions are well-informed, defensible, and aligned with the company's values and regulatory obligations. Question 3. Risk assessment procedures indicate that a long-term client who has consistently expressed a high tolerance for risk and a desire for aggressive growth has recently experienced significant personal financial setbacks that have substantially reduced their liquid assets and increased their debt obligations. Despite these changes, the client reiterates their desire for high-risk, high-return investments during a portfolio review. Which of the following actions best adheres to regulatory and ethical obligations? Option A. Adjust the investment strategy to include a slightly higher allocation to riskier assets than initially recommended to appease the client's stated preference while attempting to mitigate some risk. Option B. Inform the client that their financial situation makes aggressive investing inappropriate and refuse to manage their portfolio going forward. Option C. Recommend a more conservative investment strategy that aligns with the client's current financial capacity and ability to withstand losses, while clearly explaining the rationale and potential impact on growth objectives. Option D. Proceed with the client's requested aggressive investment strategy, as their stated risk tolerance has not changed, and the advisor's role is to execute client instructions. Correct answer is D. Proceed with the client's requested aggressive investment strategy, as their stated risk tolerance has not changed, and the advisor's role is to execute client instructions. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's stated risk tolerance and their actual investment behavior, coupled with the fiduciary duty of an advisor to act in the client's best interest. The advisor must navigate the subjective nature of risk tolerance, which can be influenced by emotional factors and market sentiment, and reconcile it with objective investment principles and regulatory requirements. The core difficulty lies in ensuring that investment recommendations align with both the client's stated preferences and their capacity to withstand potential losses, without succumbing to pressure or misinterpreting their true financial goals. The correct approach represents best professional practice because it prioritizes a thorough, documented, and objective assessment of the client's financial situation and risk capacity, rather than solely relying on a potentially volatile stated risk tolerance. This aligns with regulatory frameworks that mandate suitability and fiduciary responsibilities, such as those enforced by the Securities and Exchange Commission, SEC, in the United States. Specifically, regulations like the Investment Advisors Act of 1940 require investment advisors to act in the best interest of their clients, which includes understanding their financial situation, investment objectives, and risk tolerance. A comprehensive assessment, including a review of financial statements and a discussion of potential downside scenarios, ensures that recommendations are not only suitable but also ethically sound, safeguarding the client from undue risk and potential financial harm. This proactive and diligent approach builds trust and demonstrates a commitment to the client's long-term financial well-being. An incorrect approach that relies solely on the client's verbal assertion of a high risk tolerance, despite evidence of financial fragility, fails to uphold the fiduciary duty. This could lead to recommendations that are unsuitable, exposing the client to losses they cannot financially or emotionally absorb. This constitutes a regulatory failure under SEC rules, as it neglects the advisor's obligation to conduct a reasonable investigation into the client's circumstances. Another incorrect approach, which involves overriding the client's stated risk tolerance without sufficient justification and documentation, also presents a regulatory and ethical issue. While the advisor may believe they are acting in the client's best interest, unilaterally making such decisions without clear client consent and a robust rationale can be seen as overstepping boundaries and potentially violating the client's autonomy. This could also lead to a breach of trust and potential complaints. The professional decision-making process for similar situations should involve a structured, multifaceted approach. First, conduct a comprehensive discovery process to understand the client's financial situation, investment objectives, time horizon, and liquidity needs. Second, assess the client's risk capacity, which is their ability to absorb losses, by reviewing their financial statements and understanding their income, expenses, and net worth. Third, discuss risk tolerance, acknowledging its subjective nature and exploring how market volatility might affect their emotional response. Fourth, document all discussions, assessments, and decisions thoroughly. Fifth, present a range of suitable investment options that align with the client's overall profile, clearly explaining the risks and potential rewards of each. Finally, ensure the client understands and agrees with the recommended course of action, reinforcing the collaborative nature of the advisor-client relationship. Question 4. The evaluation methodology shows a scenario where a client expresses significant dissatisfaction with their investment portfolio's recent underperformance and demands immediate, aggressive strategies to recoup losses. As a financial advisor operating under U.S. federal securities laws, what is the most appropriate course of action? Option A. Immediately implement high-risk, aggressive investment strategies as requested by the client to attempt a rapid recovery of losses. Option B. Recommend investment products that offer higher potential returns and commissions, regardless of the client's specific risk profile. Option C. Dismiss the client's concerns and maintain the current portfolio without any adjustments, citing market volatility. Option D. Conduct a comprehensive review of the client's financial situation, risk tolerance, and investment objectives to develop a revised, suitable investment strategy that balances recovery with long-term goals. The correct answer is D. Conduct a comprehensive review of the client's financial situation, risk tolerance, and investment objectives to develop a revised, suitable investment strategy that balances recovery with long-term goals. Explanation. The evaluation methodology shows a scenario where a financial advisor is presented with a client's investment portfolio that has experienced significant underperformance. The challenge lies in balancing the client's immediate desire for aggressive recovery with the advisor's fiduciary duty to act in the client's best interest, considering risk tolerance and long-term financial goals. This requires a nuanced understanding of investment principles, regulatory obligations, and ethical considerations, particularly under the U.S. regulatory framework governing investment advisors. The correct approach involves a thorough review of the client's financial situation, risk tolerance, and investment objectives, followed by a reasoned recommendation for a diversified portfolio adjustment that aligns with these factors, even if it doesn't promise immediate high-risk returns. This aligns with the Securities and Exchange Commission (SEC) regulations, specifically the Investment Advisors Act of 1940, which mandates a fiduciary duty. This duty requires advisors to place their clients' interests above their own and to provide advice that is suitable for the client's circumstances. A recommendation based on a comprehensive understanding of the client's profile, rather than solely on the client's expressed desire for quick gains, upholds this fiduciary standard and promotes long-term client financial well-being. An incorrect approach would be to immediately implement aggressive, high-risk strategies solely to appease the client's desire for rapid recovery. This fails to adequately assess the client's risk tolerance and could lead to further losses, violating the fiduciary duty and potentially breaching SEC regulations regarding suitability. Another incorrect approach would be to dismiss the client's concerns and refuse to make any adjustments, which could be seen as a failure to act in the client's best interest and a disregard for their expressed dissatisfaction, potentially leading to a breach of the advisor-client relationship and regulatory scrutiny. A third incorrect approach might involve recommending products that generate higher commissions for the advisor, even if they are not the most suitable for the client, which is a clear violation of the fiduciary duty and ethical standards. Professionals should approach such situations by first actively listening to the client's concerns and understanding their emotional response to the underperformance. This should be followed by a systematic review of the client's financial plan, risk profile, and investment objectives. Recommendations should then be data-driven, transparent, and clearly explained, focusing on the rationale behind the proposed strategy and its alignment with the client's long-term goals, even if it means managing expectations about immediate returns. Question 5. The risk matrix shows a client's stated risk tolerance as moderate, yet their recent trading activity, as evidenced by portfolio adjustments, indicates a consistent pattern of investing in high-volatility assets and frequent speculative trades, significantly exceeding a moderate risk profile. The client has also expressed satisfaction with recent short-term gains. What is the most appropriate course of action for the financial advisor? Option A. Advise the client that their trading behavior is inconsistent with their stated risk tolerance and suggest they seek advice from a more specialized advisor who caters to aggressive trading strategies. Option B. Continue with the current investment strategy, assuming the client's actions reflect their true, albeit unstated, risk appetite and that their satisfaction with gains supersedes their initial stated tolerance. Option C. Schedule a meeting with the client to discuss the observed trading patterns, explain the discrepancy between their stated risk tolerance and their investment behavior, and reevaluate their risk profile and investment objectives to ensure alignment. Option D. Immediately adjust the portfolio to strictly adhere to a moderate risk profile, regardless of the client's recent actions or stated satisfaction with gains, to mitigate potential future losses. The correct answer is C. Schedule a meeting with the client to discuss the observed trading patterns, explain the discrepancy between their stated risk tolerance and their investment behavior, and reevaluate their risk profile and investment objectives to ensure alignment. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's stated risk tolerance and their actual investment behavior, coupled with the pressure to maintain a client relationship. The advisor must navigate this discrepancy while adhering to fiduciary duties and regulatory requirements. Careful judgment is required to ensure the client's best interests are prioritized over potential short-term relationship preservation or revenue generation. The correct approach represents best professional practice because it directly addresses the observed misalignment between the client's stated risk tolerance and their investment actions. This aligns with regulatory frameworks, such as those governing investment advisors in the United States, e.g., The Investment Advisors Act of 1940 and associated SEC rules, which mandate that advisors act in the client's best interest, conduct thorough suitability assessments, and ensure investment recommendations are appropriate for the client's objectives, financial situation, and risk tolerance. Proactively engaging the client to understand the reasons for their actions and reevaluating their risk profile is a cornerstone of responsible financial advice. An incorrect approach that involves proceeding with investments that clearly exceed the client's stated risk tolerance, despite the observed behavior, represents a failure to uphold the fiduciary duty. This could lead to significant financial harm to the client if market downturns occur, and would likely violate suitability rules. Ethically, it prioritizes the advisor's convenience or potential for higher commissions over the client's well-being. Another incorrect approach, such as ignoring the discrepancy and continuing with the current investment strategy without further inquiry, demonstrates a lack of diligence and a failure to monitor the client's portfolio in light of their stated risk tolerance. This passive approach can lead to unintended consequences and a breach of the advisor's responsibility to provide ongoing, appropriate advice. It also fails to address the potential for the client to be acting on misinformation or emotional impulses, which an advisor should help mitigate. A third incorrect approach, which might involve immediately terminating the relationship without attempting to understand or rectify the situation, could be seen as an abdication of responsibility, especially if the discrepancy is minor or a result of a misunderstanding. While difficult client relationships exist, a professional advisor should first attempt to engage, educate, and realign expectations before resorting to termination, unless the situation poses an unmanageable risk or ethical dilemma. The professional decision-making process for similar situations should involve 1. Recognizing and documenting discrepancies between stated preferences and actual behavior. 2. Initiating a dialogue with the client to understand the root cause of the behavior. 3. Reassessing the client's risk tolerance and objectives based on both stated preferences and observed actions. 4. Recommending adjustments to the investment strategy to align with the reassessed profile. 5. Documenting all discussions, decisions, and actions taken. 6. Escalating to compliance or senior management if significant ethical or regulatory concerns arise that cannot be resolved directly with the client. Question 6. Stakeholder feedback indicates that a high-net-worth client is seeking to significantly reduce their current tax liability through aggressive investment strategies. The client has expressed a strong desire to minimize taxable income this year, even if it involves complex financial instruments and structures that may have uncertain long-term implications. The firm's compliance department has flagged some of the proposed strategies as potentially high risk and requiring further scrutiny under current tax legislation. Which of the following approaches best navigates this situation professionally and ethically? Option A. Proceed with the client's preferred aggressive tax minimization strategies as requested, assuming the client understands and accepts the associated risks to maintain client satisfaction and secure the firm's revenue from the transaction. Option B. Conduct a comprehensive review of the client's entire financial picture, risk tolerance, and long-term objectives. Simultaneously, perform in-depth due diligence on the proposed tax minimization strategies, consulting with tax law experts if necessary, to ensure they are legally compliant, sustainable, and aligned with the client's overall financial well-being, while clearly communicating any identified risks and limitations to the client. Option C. Focus solely on implementing the most aggressive tax reduction strategies that appear to be technically permissible under a superficial reading of tax laws, prioritizing the immediate tax savings for the client over any potential long-term consequences or the client's broader financial health. Option D. Immediately reject all aggressive tax minimization strategies proposed by the client, citing the firm's conservative risk appetite, without fully investigating their legality or potential benefits to avoid any potential compliance issues for the firm. Correct answer is B. Conduct a comprehensive review of the client's entire financial picture, risk tolerance, and long-term objectives. Simultaneously, perform in-depth due diligence on the proposed tax minimization strategies, consulting with tax law experts if necessary, to ensure they are legally compliant, sustainable, and aligned with the client's overall financial well-being, while clearly communicating any identified risks and limitations to the client. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's desire for aggressive tax minimization and the fiduciary duty to act in the client's best interest, which includes ensuring compliance with tax laws and avoiding undue risk. The complexity arises from interpreting the nuances of tax regulations and the potential for aggressive strategies to cross the line into non-compliance or even evasion. Careful judgment is required to balance client objectives with legal and ethical obligations. The correct approach represents best professional practice because it prioritizes a thorough understanding of the client's financial situation and risk tolerance, coupled with a diligent review of applicable tax laws and regulations. This ensures that any recommended strategies are not only legally sound, but also appropriate for the client's specific circumstances, thereby upholding the fiduciary duty and mitigating the risk of future penalties or reputational damage. This aligns with the principles of professional conduct that emphasize integrity, competence, and acting in the client's best interest, as generally expected within financial advisory roles. An incorrect approach that focuses solely on aggressive tax reduction, without adequate due diligence on the legality and sustainability of the strategies, fails to uphold the fiduciary duty. This could lead to the client facing penalties, interest, and legal challenges from tax authorities, directly contravening the obligation to act in the client's best interest. Another incorrect approach that dismisses the client's concerns about potential tax liabilities without a proper investigation into the validity of those concerns demonstrates a lack of diligence and could result in missed opportunities for legitimate tax planning or, conversely, expose the client to unforeseen risks. A third incorrect approach that prioritizes the firm's revenue generation over the client's long-term financial well-being by pushing unsuitable or overly aggressive products would be a clear breach of ethical conduct and fiduciary responsibility. Professionals should employ a decision-making framework that begins with a comprehensive client needs assessment, including their risk appetite and financial goals. This should be followed by a rigorous analysis of relevant laws and regulations. Recommendations should then be developed, clearly articulating the potential benefits, risks, and compliance implications of each strategy. Open and transparent communication with the client, ensuring they understand the rationale and potential outcomes, is paramount. If a client's request pushes the boundaries of legality or ethical practice, the professional must clearly explain these limitations and propose compliant alternatives. Question 7. Process analysis reveals that a client has expressed a strong desire to significantly reduce their tax liability through aggressive strategies, hinting at methods that may push the boundaries of tax law. As a financial advisor, you are tasked with responding to this request. Which of the following actions best aligns with professional and regulatory expectations? Option A. Inform the client that their request for aggressive tax reduction is beyond the scope of your services and suggest they seek advice from a tax attorney specializing in tax evasion. Option B. Immediately implement the most aggressive tax reduction strategies suggested by the client, assuming their intent is to minimize tax obligations by any means necessary. Option C. Advise the client that while you cannot assist with illegal activities, you can explore highly aggressive, albeit technically legal, strategies that exploit complex loopholes even if they lack economic substance. Option D. Engage in a detailed discussion with the client to understand the specific nature of their desired tax reduction. Explain the legal framework surrounding tax planning and evasion, and propose compliant strategies that achieve their objectives within the bounds of the law. The correct answer is D. Engage in a detailed discussion with the client to understand the specific nature of their desired tax reduction, explain the legal framework surrounding tax planning and evasion, and propose compliant strategies that achieve their objectives within the bounds of the law. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's stated desire for aggressive tax avoidance and the fiduciary duty of an advisor to act in the client's best interest, which includes compliance with tax laws and regulations. The advisor must navigate the fine line between legitimate tax planning and potentially illegal tax evasion, requiring careful judgment and a thorough understanding of applicable tax codes. The correct approach represents best professional practice because it prioritizes ethical conduct and regulatory compliance. By seeking clarification on the client's objectives and explaining the legal boundaries of tax planning, the advisor upholds their fiduciary duty. This involves educating the client on permissible strategies that align with tax laws, thereby protecting both the client from legal repercussions and the advisor from professional misconduct. This aligns with the principles of integrity and due care expected of financial professionals. An incorrect approach that focuses solely on fulfilling the client's request for aggressive tax avoidance without considering legal implications would be professionally unacceptable. This would constitute a failure to act in the client's best interest, as it exposes them to significant legal and financial risks, including penalties and potential criminal charges for tax evasion. Such an approach also violates the advisor's ethical obligation to uphold the law and could lead to disciplinary action by regulatory bodies. Another incorrect approach that involves recommending strategies that are technically legal but highly aggressive and designed to exploit loopholes without genuine economic substance would also be problematic. While not outright illegal, such strategies can be viewed as promoting tax avoidance that borders on evasion and may be challenged by tax authorities. This approach lacks the integrity and transparency expected of professional advice and could damage the client's reputation and lead to future tax disputes. A professional decision-making process for similar situations should involve a structured approach. 1. Understand the client's objectives thoroughly, asking clarifying questions to discern their true intent and risk tolerance. 2. Educate the client on the relevant tax laws and regulations, clearly outlining what constitutes legitimate tax planning versus illegal tax evasion. 3. Propose a range of compliant tax planning strategies that align with the client's financial goals and risk profile. 4. Document all advice provided, including discussions about risks and legal boundaries, to create a clear audit trail. 5. If a client insists on pursuing strategies that are clearly illegal or ethically questionable, the professional should decline to provide advice on those specific strategies and consider terminating the professional relationship if the client remains unwilling to comply with legal requirements. Question 8. Operational review demonstrates a client is seeking to implement a complex financial arrangement designed to significantly reduce their reported taxable income. The proposed strategy involves a series of transactions that, while appearing to have some economic substance, are primarily structured to generate tax losses that are disproportionate to the actual economic risk undertaken. The firm's tax advisors are aware of IRS pronouncements and judicial decisions that scrutinize such arrangements for potential tax avoidance abuse. What is the most appropriate course of action for the firm? Option A. Immediately refuse to engage with the client on this matter without further discussion or explanation. Option B. Recommend the client seek advice from another firm that specializes in more aggressive tax planning techniques. Option C. Proceed with implementing the client's proposed strategy as requested, assuming the client understands and accepts any potential risks. Option D. Advise the client on the potential risks and legal limitations of the proposed strategy, citing relevant IRS guidance and case law, and offer to explore alternative, compliant tax minimization strategies. The correct answer is D. Advise the client on the potential risks and legal limitations of the proposed strategy, citing relevant IRS guidance and case law, and offer to explore alternative, compliant tax minimization strategies. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's desire for aggressive tax avoidance and the firm's obligation to adhere to tax laws and ethical standards. The firm must navigate the fine line between legitimate tax planning and illegal tax evasion, requiring a deep understanding of the U.S. tax code and relevant IRS guidance. The correct approach represents best professional practice because it prioritizes compliance with U.S. tax law and ethical obligations. It involves a thorough analysis of the client's situation against established tax principles, seeking to minimize tax liability within legal boundaries. This aligns with the ICPA Code of Professional Conduct, specifically the principles of integrity, objectivity, and due care, as well as IRS Circular 230, which governs practice before the IRS and emphasizes the practitioner's duty to advise clients accurately and to not engage in frivolous tax shelters. This approach ensures the firm protects its reputation and avoids potential penalties for aiding and abetting tax evasion. An incorrect approach that suggests aggressively pursuing the client's proposed strategy without sufficient legal justification fails to uphold the practitioner's duty of due diligence. This could lead to the client facing significant penalties, interest, and potential criminal charges for tax evasion. Ethically, it violates the principle of integrity by knowingly facilitating potentially illegal activities. From a regulatory standpoint, it contravenes IRS regulations that prohibit the promotion or use of abusive tax shelters and could result in professional sanctions against the practitioner, including suspension or revocation of their right to practice before the IRS. Another incorrect approach that involves simply refusing to engage with the client's request without offering alternative compliance strategies is professionally suboptimal. While it avoids direct complicity in potential wrongdoing, it fails to provide the client with the expected professional service of tax planning. A more constructive approach would be to explain the legal limitations and then offer to explore legitimate tax minimization strategies that are compliant with U.S. tax law. This demonstrates a commitment to client service while maintaining ethical and legal boundaries. The professional reasoning process for similar situations should involve a multi-step evaluation. 1. Understand the client's objective and the proposed strategy. 2. Thoroughly research the relevant U.S. tax laws, IRS regulations, and judicial precedents pertaining to the proposed strategy. 3. Assess the legal viability and risk profile of the proposed strategy. 4. If the strategy appears to be legally questionable or potentially abusive, clearly communicate the risks and legal limitations to the client, citing specific regulations or guidance. 5. Offer to explore alternative compliant tax planning strategies that align with the client's overall financial goals. 6. Document all advice provided and the client's decisions. 7. If the client insists on pursuing a strategy that the professional believes is illegal or unethical, the professional must disengage from the engagement. Question 9. Stakeholder feedback indicates a potential investment opportunity has arisen through a personal connection of a senior investment manager. This opportunity involves acquiring a significant stake in a private company that is not publicly traded. The personal connection is offering the stake at a price that appears attractive, but no independent valuation has been conducted. The senior manager believes this could be a lucrative opportunity for the firm's clients, but is aware of the potential for perceived or actual conflicts of interest due to the personal relationship. The firm operates under U.S. securities regulations. Which of the following approaches best navigates this situation in compliance with U.S. regulatory frameworks and ethical best practices? Option A. Proceed with the investment immediately at the offered price, as the personal connection has assured the senior manager of its attractiveness, and inform clients of the acquisition after it has been completed. Option B. Obtain an independent third-party valuation of the private company and ensure all terms of the transaction are at fair market value, with full disclosure to all affected clients and relevant internal compliance departments before proceeding. Option C. Decline the investment opportunity outright due to the personal connection to avoid any potential for conflicts of interest, regardless of the investment's potential merits. Option D. Disclose the potential investment opportunity to all clients simultaneously, allowing them to express interest, and then proceed with the investment based on client demand and the senior manager's assessment. The correct answer is B. Obtain an independent third-party valuation of the private company and ensure all terms of the transaction are at fair market value, with full disclosure to all affected clients and relevant internal compliance departments before proceeding. Explanation. This scenario presents a professional challenge because it requires an individual to navigate conflicting stakeholder interests while adhering to strict regulatory requirements and ethical obligations. The core difficulty lies in balancing the desire for immediate financial gain with the long-term fiduciary duties owed to clients and the need for transparency and fairness in investment decisions. Careful judgment is required to ensure that any proposed action is not only profitable, but also compliant and ethically sound, avoiding any appearance of impropriety or preferential treatment. The correct approach represents best professional practice because it prioritizes client interests and regulatory compliance above all else. By seeking independent, objective advice and ensuring that any transaction is conducted at fair market value with full disclosure, it upholds the principles of fiduciary duty and avoids conflicts of interest. This aligns with the regulatory framework that mandates acting in the best interests of clients, preventing insider trading, and maintaining market integrity. It demonstrates a commitment to ethical conduct and robust governance, which are paramount in the financial services industry. An incorrect approach that involves proceeding with the investment without independent valuation fails to meet the fiduciary standard. It creates a significant conflict of interest, as the individual's personal relationship with the seller could unduly influence the decision-making process, potentially leading to a suboptimal outcome for the client. This could violate regulations requiring fair dealing and prudent investment practices. Another incorrect approach, which involves disclosing the potential investment opportunity to other clients before a formal decision is made, risks creating an unfair advantage for some clients over others. This could lead to accusations of selective disclosure or market manipulation, depending on the nature of the information and the clients involved. It undermines the principle of equal treatment and could violate regulations designed to prevent information asymmetry. A third incorrect approach, which is to reject the opportunity solely based on the personal relationship, might be overly cautious and could deprive clients of a potentially beneficial investment. While avoiding conflicts is important, a blanket rejection without proper due diligence and consideration of the investment's merits might not be in the client's best interests. The professional reasoning process should involve a thorough assessment of the investment's suitability, a rigorous conflict of interest analysis, and adherence to all applicable regulations and internal policies. This includes obtaining independent valuations, ensuring full disclosure, and documenting all decisions and justifications. Question 10. System analysis indicates that an employee of an investment firm, aware of upcoming significant client trades in a particular security, considers executing a personal trade in the same security shortly before the client trades are executed. The employee believes their personal trade is small enough not to influence the market or be considered material. Which of the following actions best aligns with regulatory expectations and professional ethics for personal trading? Option A. Execute the personal trade and disclose it only after the client trades have been completed to avoid any appearance of impropriety during the transaction window. Option B. Proceed with the personal trade, as the employee's judgment about materiality and impact is sufficient for compliance. Option C. Execute the personal trade after confirming it is not material and will not impact client trades, as personal trading is a right. Option D. Immediately cease any consideration of the personal trade and consult the firm's compliance department regarding the firm's personal trading policy and the potential conflict of interest. The correct answer is C. Execute the personal trade after confirming it is not material and will not impact client trades, as personal trading is a right. Explanation. Scenario analysis. This scenario presents a challenge in balancing the fiduciary duty to act in the best interests of clients with the potential for personal gain through proprietary trading. The core difficulty lies in identifying and managing the inherent conflict of interest that arises when an employee of an investment firm engages in personal trading that could be influenced by or influence the firm's client activities. This requires a robust understanding of regulatory expectations regarding personal trading and the prevention of market abuse. Correct approach analysis. The correct approach involves adhering strictly to the firm's established policies and procedures for personal trading, which are designed to comply with relevant regulations. This includes pre-clearance of trades, disclosure of holdings, and adherence to blackout periods. Such a framework ensures transparency, mitigates conflicts of interest, and prevents insider trading or front-running. This aligns with the principles of acting with integrity and due diligence, as mandated by regulatory bodies overseeing financial markets, ensuring that client interests are always prioritized over personal gain. Incorrect approaches analysis. One incorrect approach involves executing trades without prior approval, even if the employee believes the trades are not material or could not impact clients. This bypasses the firm's internal controls and regulatory oversight designed to detect and prevent market abuse. It represents a failure of due diligence and a disregard for the firm's compliance policies, potentially leading to violations of regulations, prohibiting insider trading and market manipulation. Another incorrect approach is to rely on personal judgment about the insignificance of a trade to avoid disclosure. This is a subjective assessment that is insufficient to meet regulatory requirements. Regulations typically mandate disclosure and pre-clearance for all personal trading activities, regardless of perceived materiality, to maintain a comprehensive audit trail and prevent even the appearance of impropriety. This approach demonstrates a lack of understanding of the strictness of regulatory frameworks and the importance of objective compliance. A further incorrect approach is to engage in trading activities that mirror or are closely related to recent or ongoing client transactions. This creates a significant risk of front-running or insider trading, even if no confidential information is directly used. The appearance of such activity can erode market confidence and lead to severe regulatory penalties. It demonstrates a failure to appreciate the broad scope of regulations designed to protect market integrity and client fairness. Professional reasoning. Professionals should adopt a proactive and transparent approach to personal trading. This involves thoroughly understanding and consistently applying the firm's compliance policies, which are rooted in regulatory requirements. When in doubt about the appropriateness of a trade, seeking guidance from the compliance department is paramount. This decision-making process prioritizes adherence to rules, ethical conduct, and the protection of client interests, thereby safeguarding both the individual's career and the firm's reputation. Question 11. Compliance review shows that an investment advisor is considering recommending a mutual fund to a client. The client has expressed a desire for long-term growth and has a moderate risk tolerance. Two funds are under consideration. Fund A, which aligns well with the client's growth objective and moderate risk tolerance, but offers the advisor a lower commission, and Fund B, which also offers growth potential but carries a slightly higher risk profile and generates a significantly higher commission for the advisor. The advisor has not yet made a recommendation. Which approach best upholds the advisor's professional and regulatory obligations? Option A. Recommend Fund B, emphasizing its growth potential, and highlight that the higher commission reflects the superior performance potential of the fund. Option B. Recommend Fund A, as it most closely aligns with the client's stated objectives and risk tolerance, and disclose the compensation difference to the client. Option C. Recommend Fund A but do not mention Fund B, as the client may be confused by too many options. Option D. Recommend Fund B due to the higher commission, as it still offers growth potential, and the client's stated desire for growth can be interpreted broadly. The correct answer is B. Recommend Fund A, as it most closely aligns with the client's stated objectives and risk tolerance, and disclose the compensation difference to the client. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between a client's stated investment objectives and the potential for a product to generate higher fees for the advisor. The advisor must navigate the fiduciary duty owed to the client, which mandates acting in the client's best interest, against the temptation of recommending a product that, while potentially suitable, is demonstrably more lucrative for the advisor. This requires a high degree of ethical judgment and a thorough understanding of regulatory obligations concerning suitability and disclosure. Correct approach analysis. The correct approach prioritizes the client's best interest by recommending the product that aligns most closely with their stated objectives and risk tolerance, even if it yields lower compensation. This aligns with the core principles of fiduciary duty, as mandated by regulations such as the Investment Advisors Act of 1940 in the U.S., which requires investment advisors to act with undivided loyalty and utmost good faith towards their clients. It also adheres to suitability rules, ensuring that recommendations are appropriate for the client's financial situation, investment objectives, and risk tolerance. Transparency regarding compensation structures is also paramount, ensuring no undue influence on the recommendation. Incorrect approaches analysis. Recommending the higher fee product solely because it offers greater compensation, despite a more suitable alternative existing, constitutes a breach of fiduciary duty. This prioritizes the advisor's financial gain over the client's well-being, violating the principle of acting in the client's best interest. It also fails to meet suitability standards, as the recommendation is not solely based on the client's needs. Furthermore, failing to disclose the differential compensation structure creates a conflict of interest that is not adequately managed, potentially misleading the client. Recommending the lower fee product, but failing to fully disclose the existence and potential benefits of the higher fee product, even if less suitable, is also problematic. While the primary recommendation is client-centric, the omission of relevant information about other available options, especially those that might be considered by some investors, even if not ideal for this specific client, could be seen as incomplete disclosure. This can undermine the client's ability to make fully informed decisions, focusing exclusively on the client's stated desire for growth, without adequately assessing their risk tolerance or understanding the specific nature of the growth they seek, e.g., Aggressive vs. moderate is an incomplete suitability analysis. While growth is a stated objective, a responsible advisor must probe deeper to ensure the recommended product's risk profile matches the client's capacity and willingness to bear risk. This can lead to unsuitable recommendations if the advisor doesn't fully understand the client's true needs and limitations. Professional reasoning. Professionals should employ a structured decision-making process that begins with a comprehensive understanding of the client's financial situation, objectives, and risk tolerance. This involves active listening, probing questions, and a thorough review of relevant documentation. Next, advisors must identify all suitable investment options that meet these criteria, considering various products and their associated costs and benefits. A critical step is to compare these suitable options, objectively evaluating them against the client's needs and the advisor's compensation structure. Transparency is key. Any potential conflicts of interest, including differential compensation, must be clearly disclosed to the client. The final recommendation should be the option that best serves the client's interests, supported by a clear rationale that can be explained to the client. Question 12. Market research demonstrates that clients often seek to minimize their tax liabilities. An advisor is approached by a new client who expresses a strong desire to significantly reduce their current year's tax burden. The client has presented a complex proposal involving a series of transactions that appear to generate substantial tax deductions, but the underlying economic substance of these transactions is questionable and may not align with the client's long-term business operations. The advisor must determine the most appropriate course of action. Option A. Inform the client that the proposed transactions are too complex to analyze and suggest they seek advice from another professional without further engagement. Option B. Advise the client on the potential risks and legal implications of the proposed transactions, including the possibility of them being challenged by the IRS as lacking economic substance or being an abusive tax shelter, and recommend alternative, more sustainable tax planning strategies that align with the client's overall financial health and business objectives. Option C. Immediately implement the client's proposed transactions as requested, focusing solely on maximizing the immediate tax deductions to meet the client's stated objective of reducing their current year's tax liability. Option D. Proceed with the client's proposed transactions, but advise the client to omit certain details from their tax filings to avoid drawing undue attention from the IRS. The correct answer is B. Advise the client on the potential risks and legal implications of the proposed transactions, including the possibility of them being challenged by the IRS as lacking economic substance or being an abusive tax shelter, and recommend alternative, more sustainable tax planning strategies that align with the client's overall financial health and business objectives. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's desire for aggressive tax minimization and the fiduciary duty of an advisor to act in the client's best interest while adhering to tax laws and ethical guidelines. The advisor must navigate the fine line between legitimate tax planning and potentially aggressive or abusive tax avoidance schemes. Careful judgment is required to ensure that any recommended strategies are compliant, sustainable, and truly beneficial to the client in the long term, rather than creating future liabilities or reputational damage. The correct approach represents best professional practice because it prioritizes a comprehensive understanding of the client's financial situation, risk tolerance, and long-term objectives. It involves a thorough review of relevant tax legislation and guidance, seeking expert opinions when necessary, and clearly communicating the risks and benefits of any proposed strategy. This aligns with the ethical obligation to provide informed advice and act with due diligence, ensuring that recommendations are not only legally permissible, but also prudent and aligned with the client's overall financial well-being. In the U.S. context, this would involve adherence to IRS regulations, Circular 230, and professional body standards, e.g., AICPA, CFP Board, which emphasize competence, integrity, and client best interests. An incorrect approach that focuses solely on aggressive tax reduction without considering the underlying economic substance or potential for challenge by tax authorities represents a significant regulatory and ethical failure. This could lead to penalties, interest, and reputational damage for both the client and the advisor. Specifically, recommending strategies that lack economic substance or are designed primarily to generate tax benefits without a corresponding business purpose could be deemed an abusive tax shelter, violating IRS regulations and potentially Circular 230. Another incorrect approach that involves misrepresenting facts or omitting material information to tax authorities is a direct violation of ethical codes and tax laws, constituting fraud. Furthermore, failing to adequately disclose the risks associated with a particular tax strategy, or not obtaining informed consent from the client regarding those risks, breaches the duty of care and transparency. The professional decision-making process for similar situations should involve a structured approach. 1. Understand the client's objectives. Clearly define the client's financial goals, risk appetite, and the specific reasons for seeking tax minimization. 2. Gather information. Collect all relevant financial data, tax returns, and documentation. 3. Research and analysis. Thoroughly research applicable tax laws, regulations, and IRS guidance. Identify potential strategies and their implications. 4. Risk assessment. Evaluate the potential risks associated with each strategy, including legal, financial, and reputational risks. Consider the likelihood of challenge by tax authorities. 5. Develop recommendations. Formulate strategies that are compliant, ethically sound, and aligned with the client's objectives. 6. Communicate clearly. Present the recommended strategies to the client, explaining the benefits, risks, costs, and any potential downsides in a clear and understandable manner. Obtain informed consent. 7. Document everything. Maintain detailed records of all advice, analysis, client communications, and decisions made. Question 13. Assessment of an investment advisor's responsibility when a client expresses a strong desire for aggressive growth, but the advisor identifies a product with a history of high volatility and significant downside risk that may not align with the client's overall financial stability. Option A. Conduct a thorough assessment of the client's complete financial situation, risk tolerance, and investment objectives to determine if the aggressive growth product is truly suitable, and if so, clearly explain all associated risks and potential downsides to the client. Option B. Focus only on the potential upside of the aggressive growth product, highlighting its historical performance without delving into its inherent risks or the client's capacity to absorb potential losses. Option C. Suggest a highly speculative, unregistered security that promises exceptionally high returns, believing it will satisfy the client's aggressive growth objective. Option D. Recommend the aggressive growth product immediately, as the client's stated desire for aggressive growth should be the primary determinant of the investment recommendation. The correct answer is A. Conduct a thorough assessment of the client's complete financial situation, risk tolerance, and investment objectives to determine if the aggressive growth product is truly suitable, and if so, clearly explain all associated risks and potential downsides to the client. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's stated investment objective and the potential risks associated with a specific investment product. The advisor must navigate the client's desire for aggressive growth against the backdrop of regulatory obligations to ensure suitability and prevent misrepresentation. Berkshire Hathaway, operating within the U.S. regulatory framework, is bound by rules that prioritize client interests and mandate a thorough understanding of both the client's profile and the investment's characteristics. The correct approach represents best professional practice because it prioritizes a comprehensive understanding of the client's financial situation, risk tolerance, and investment objectives before recommending any product. This aligns with the fiduciary duty often implied or explicitly stated in U.S. financial regulations, such as those enforced by the SEC and FINRA. It ensures that any recommendation is suitable for the client, thereby mitigating the risk of financial harm and regulatory noncompliance. This approach emphasizes due diligence and client-centric advice, which are cornerstones of ethical financial advisory. An incorrect approach that focuses solely on the client's stated desire for aggressive growth without a deeper assessment of their capacity for risk or the product's specific volatility would be a regulatory and ethical failure. This could lead to a recommendation that is unsuitable, potentially exposing the client to losses they cannot absorb. Another incorrect approach, such as recommending a product based on its historical performance alone without considering its current market conditions or the client's specific circumstances, also fails to meet regulatory standards for due diligence and suitability. Furthermore, an approach that downplays or omits material risks associated with the investment to secure a sale would constitute a misrepresentation and a breach of ethical conduct, violating regulations against deceptive practices. Professionals should employ a decision-making framework that begins with a thorough client discovery process, gathering detailed information about their financial goals, risk tolerance, time horizon, and liquidity needs. This is followed by a rigorous analysis of potential investment products, evaluating their risk-return profiles, fees, liquidity, and suitability for the identified client profile. The final step involves clearly communicating the risks and benefits of any recommended investment to the client, ensuring they make an informed decision. This systematic process ensures compliance with regulatory requirements and upholds ethical standards. Question 14. Comparative studies suggest that when advising clients on tax strategies, the primary consideration should be the client's stated desire for aggressive tax minimization, even if it pushes the boundaries of current tax law. Option A. Focus on identifying and exploiting any perceived ambiguities or loopholes in tax legislation that can legally reduce the client's tax liability, regardless of the underlying economic substance of the transactions. Option B. Implement the client's proposed tax minimization strategy without extensive independent review, assuming the client has sought advice from other sources and is aware of the potential risks. Option C. Prioritize a thorough analysis of the proposed strategy's compliance with the Internal Revenue Code, Treasury regulations, and established tax principles, including the economic substance doctrine, and advise the client on the associated risks and potential consequences of any aggressive interpretation. Option D. Advise the client to engage in transactions that may not have a clear business purpose, but are structured to generate specific tax benefits, emphasizing that the legality of such strategies is often determined by court interpretations that evolve over time. The correct answer is C. Prioritize a thorough analysis of the proposed strategy's compliance with the Internal Revenue Code, Treasury regulations, and established tax principles, including the economic substance doctrine, and advise the client on the associated risks and potential consequences of any aggressive interpretation. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's desire for aggressive tax minimization and the fiduciary duty of an advisor to ensure compliance with tax laws and ethical standards. The advisor must navigate the fine line between legitimate tax planning and potentially abusive tax avoidance schemes. Careful judgment is required to assess the substance of the proposed transactions and their alignment with the spirit and letter of tax regulations. The correct approach represents best professional practice because it prioritizes adherence to the Internal Revenue Code, IRC, and relevant Treasury regulations. It involves a thorough understanding of tax law, including the economic substance doctrine and the general anti-abuse rules, to ensure that any tax strategies proposed are legitimate and sustainable. This approach upholds the advisor's ethical obligation to act with integrity and competence, safeguarding both the client and the advisor from potential penalties and reputational damage. It demonstrates a commitment to providing sound financial advice that is grounded in legal and ethical principles. An incorrect approach that relies solely on the client's interpretation of tax law without independent verification is professionally unacceptable. This fails to meet the standard of due diligence and competence expected of a tax professional. It could lead to the client engaging in non-compliant tax practices, resulting in significant penalties, interest, and potential legal repercussions. Furthermore, it breaches the ethical duty to provide accurate and informed advice. Another incorrect approach that focuses on exploiting loopholes without considering the underlying intent of the legislation is also professionally unsound. Tax authorities often scrutinize arrangements that appear to lack economic substance or are designed primarily to achieve a tax benefit, regardless of business purpose. Such strategies are vulnerable to challenge and can be deemed abusive, leading to adverse tax consequences. This approach disregards the principles of tax fairness and compliance. A third incorrect approach that involves misrepresenting facts or the nature of transactions to tax authorities is not only unethical but also illegal. This constitutes tax fraud and carries severe penalties for both the client and the advisor. It violates fundamental ethical principles of honesty and integrity. The professional decision-making process for similar situations should involve a structured approach. 1. Understand the client's objectives thoroughly. 2. Conduct comprehensive research into the relevant tax laws and regulations. 3. Analyze the economic substance and business purpose of any proposed transaction. 4. Assess the potential risks and benefits, including the likelihood of challenge by tax authorities. 5. Clearly communicate the findings, risks, and recommendations to the client, emphasizing the importance of compliance. 6. Document all advice and client decisions meticulously. 7. If there is any doubt about the legality or ethicality of a proposed strategy, err on the side of caution and advise against it. Question 15. The performance metrics show a significant increase in market share for a key subsidiary, but a recent analysis suggests that achieving the next growth milestone will require a substantial acquisition outside of Berkshire Hathaway's traditional investment sectors. The proposed target company operates in a highly volatile industry with a complex regulatory environment, and its financial projections are optimistic but carry considerable execution risk. The CEO is eager to pursue this acquisition to maintain the subsidiary's growth trajectory and impress investors with aggressive expansion. Option A. Proceed with a preliminary agreement to acquire the target company, contingent on a rapid, high-level review of its financials and regulatory standing, with the understanding that detailed due diligence will be completed after the deal is secured to avoid losing the opportunity. Option B. Decline the acquisition outright due to the perceived risks and deviation from established investment sectors, recommending a focus on organic growth within existing profitable areas to preserve capital and minimize exposure to new market uncertainties. Option C. Immediately initiate negotiations for the acquisition, prioritizing speed to market and potential revenue synergies, and address any regulatory or integration challenges as they arise post-acquisition to capitalize on the current market momentum. Option D. Conduct a comprehensive due diligence process, focusing on the target company's regulatory compliance, long-term financial sustainability, and strategic fit with Berkshire Hathaway's core values and existing portfolio, while also assessing the potential impact on current shareholder value and seeking independent expert opinions before making a recommendation. The correct answer is D. Conduct a comprehensive due diligence process, focusing on the target company's regulatory compliance, long-term financial sustainability, and strategic fit with Berkshire Hathaway's core values and existing portfolio, while also assessing the potential impact on current shareholder value and seeking independent expert opinions before making a recommendation. Explanation. This scenario presents a professional challenge because it requires balancing the pursuit of growth and market share with the fundamental fiduciary duty to act in the best interests of existing shareholders. The pressure to meet aggressive growth targets can lead to decisions that, while potentially beneficial in the long term, might dilute the value or negatively impact the immediate financial health of current investors. Careful judgment is required to ensure that any strategic shift aligns with the company's long-term value proposition and regulatory obligations. The correct approach represents best professional practice because it prioritizes a thorough, data-driven assessment of the proposed acquisition's impact on Berkshire Hathaway's core principles and existing shareholder value. This involves a comprehensive due diligence process that scrutinizes not only the financial projections, but also the strategic fit, cultural alignment, and potential regulatory hurdles. Adhering to the established investment philosophy and risk tolerance, as well as ensuring transparency with stakeholders, are paramount. This aligns with the regulatory framework governing public companies, which mandates acting in the best interests of shareholders and maintaining sound corporate governance. An incorrect approach that focuses solely on the potential for rapid revenue growth without adequately assessing integration risks or the impact on existing business lines would be a regulatory and ethical failure. This could lead to overpaying for an acquisition, integrating incompatible cultures, or diverting resources from profitable existing operations, ultimately harming shareholder value. Another incorrect approach, which involves downplaying potential negative impacts or regulatory concerns to secure board approval for a deal driven by personal ambition or short-term gains, constitutes a breach of fiduciary duty and potentially violates securities laws regarding accurate disclosure. A third incorrect approach, which involves proceeding with the acquisition without sufficient due diligence due to time pressure, ignores the fundamental obligation to protect shareholder assets and could result in significant financial losses and reputational damage, violating principles of prudent management. Professionals should employ a decision-making framework that begins with a clear understanding of the company's strategic objectives and risk appetite. This should be followed by rigorous due diligence, involving cross-functional teams to assess all aspects of a potential transaction. Open and honest communication with the board and relevant stakeholders is crucial, ensuring that all potential risks and benefits are thoroughly understood. Finally, decisions should be grounded in a commitment to long-term shareholder value and adherence to all applicable regulations and ethical standards. Question 16. To address the challenge of a potential minor regulatory discrepancy identified during a client transaction, which is being downplayed by a senior manager who is eager to close the deal, what is the most professionally responsible course of action? Option A. Directly confront the senior manager with evidence of the discrepancy and demand an immediate correction, potentially creating an adversarial situation. Option B. Escalate the concern through the firm's established compliance channels, providing all relevant details and seeking guidance on how to proceed, even if it means delaying the transaction. Option C. Proceed with the transaction as instructed by the senior manager, assuming the discrepancy is insignificant and not worth jeopardizing the deal. Option D. Ignore the discrepancy, believing that it is too minor to have any real consequences, and that reporting it would be an overreaction. The correct answer is B. Escalate the concern through the firm's established compliance channels, providing all relevant details and seeking guidance on how to proceed, even if it means delaying the transaction. Explanation. Scenario analysis. This scenario presents a professional challenge involving potential conflicts of interest and the ethical obligation to act in the best interest of clients, even when faced with pressure from a superior. The core difficulty lies in balancing loyalty to management with fiduciary duties and regulatory compliance. A professional must navigate this situation with integrity, recognizing that short-term gains or appeasing a superior cannot override long-term ethical and legal responsibilities. The pressure to overlook a minor infraction for the sake of a deal highlights the importance of robust internal controls and a strong ethical culture. Correct approach analysis. The correct approach demonstrates a commitment to regulatory compliance and client best interests, which are paramount in the financial services industry. By escalating the concern through the appropriate channels, the professional upholds their fiduciary duty and adheres to the principles of integrity and due diligence. This aligns with the spirit and letter of regulations that require professionals to report suspicious activities or potential breaches of conduct, even if they seem minor. It also reflects best practices in risk management, where identifying and addressing even small issues proactively can prevent larger problems down the line. This approach prioritizes transparency and accountability, essential for maintaining trust with clients and regulators. Incorrect approach is analysis. One incorrect approach involves overlooking the discrepancy due to the superior's instruction. This constitutes a failure to uphold fiduciary duties and a potential violation of regulations requiring diligent oversight and reporting. It prioritizes personal expediency and loyalty to a superior over legal and ethical obligations, creating a significant compliance risk and exposing the firm to potential penalties. This action could be construed as complicity in a regulatory breach. Another incorrect approach is to directly confront the superior without a clear plan or escalation path. While direct communication can be valuable, doing so without first understanding the full scope of the issue or without a mechanism for formal reporting can lead to a breakdown in communication, potential retaliation, and an inability to effectively address the underlying problem. It bypasses established compliance procedures, which are designed to ensure issues are handled systematically and impartially. A third incorrect approach is to ignore the discrepancy altogether, assuming it is too minor to warrant attention. This demonstrates a lack of diligence and a failure to recognize that even small deviations from policy or regulation can indicate systemic weaknesses or potential future problems. It neglects the professional's responsibility to identify and report potential risks, thereby failing to protect the client and the firm. This passive approach can lead to a culture of complacency and increase the likelihood of more serious violations occurring undetected. Professional reasoning. Professionals in this situation should employ a structured decision-making process. First, they must clearly identify the potential issue and its implications, referencing relevant company policies and regulatory guidelines. Second, they should assess the severity and potential impact of the discrepancy. Third, they should consult internal compliance or legal departments to understand the proper reporting procedures and seek guidance. Fourth, they should document all communications and actions taken. This systematic approach ensures that decisions are informed, defensible, and aligned with professional standards and regulatory requirements, prioritizing integrity and client protection above all else. Question 17. The assessment process reveals that you have recently advised a high net worth individual on a significant portfolio rebalancing strategy that involves a substantial investment in a niche technology sector. You are attending a social gathering where a close personal friend, who is also an active investor, inquires about any interesting market insights you might have. You are tempted to share some general observations about the growth potential of the technology sector you've been exploring with your client, without naming the client or their specific holdings. Which of the following represents the most appropriate professional response? Option A. Mention the client's sector of investment to your friend, explaining that it's a family friend and you want to share potential opportunities. Option B. Politely decline to discuss any client-specific information or market insights derived from client activity, stating that you are bound by strict confidentiality agreements and professional ethics. Option C. Share general observations about the growth potential of the technology sector, emphasizing that these are broad market trends and not tied to any specific client. Option D. Discuss the client's investment decisions with your friend, who works at a different financial institution, as they might offer a valuable external perspective. The correct answer is B. Politely decline to discuss any client-specific information or market insights derived from client activity, stating that you are bound by strict confidentiality agreements and professional ethics. Explanation. Scenario analysis. This scenario presents a professional challenge rooted in the ethical obligation to maintain client confidentiality and the potential conflict arising from a perceived personal benefit. The pressure to share information, even if seemingly innocuous, can lead to breaches of trust and regulatory violations. Careful judgment is required to balance professional duties with personal relationships. Correct approach analysis. The correct approach demonstrates an understanding of the paramount importance of client confidentiality, a core tenet of financial advisory ethics and regulatory compliance. Sharing any non-public information about a client's investment activities, regardless of the perceived intent or the relationship with the recipient, constitutes a breach of confidentiality. This aligns with regulations that mandate the protection of client data and prohibit the misuse of material non-public information. Best professional practice dictates that all client information is treated with the utmost discretion and is only shared with authorized individuals for legitimate business purposes, adhering strictly to privacy policies and regulatory requirements. Incorrect approaches analysis. One incorrect approach involves sharing general market trends observed from client activity. This is a regulatory failure because it can indirectly reveal patterns of client behavior or investment strategies, even if specific client identities are not disclosed. This could be construed as a breach of confidentiality or, in certain contexts, as market manipulation if the information is used to influence others. Another incorrect approach is to discuss the client's investment decisions with a personal friend who works in a different financial institution. This is an ethical and regulatory failure, as it directly violates the duty of confidentiality owed to the client. It also exposes the client's sensitive financial information to an unauthorized third party, potentially creating conflicts of interest and violating data privacy laws. A third incorrect approach is to mention the client's sector of investment to a family member who is also an investor. While seemingly less direct, this still constitutes a breach of confidentiality. The client's sector of investment is non-public information, and its disclosure, even to a family member, can provide an unfair advantage or reveal aspects of the client's strategy, thereby violating the trust placed in the advisor. Professional reasoning. Professionals should employ a decision-making framework that prioritizes ethical conduct and regulatory compliance. This involves a clear understanding of confidentiality obligations, a commitment to client privacy, and a rigorous adherence to company policies and relevant laws. When faced with a situation where personal relationships might tempt a deviation from professional duties, the framework should include 1. Identifying the core ethical and regulatory obligations at play, e.g., confidentiality, data privacy. 2. Assessing the potential impact of any proposed action on the client and the firm. 3. Consulting internal policies and seeking guidance from compliance or legal departments if there is any ambiguity. 4. maintaining a strict separation between personal and professional life to prevent conflicts of interest and breaches of trust. Question 18. The assessment process reveals that a prospective client, when asked about their investment risk tolerance, states they are comfortable with very high risk to achieve aggressive growth. However, a preliminary review of their financial profile indicates a relatively short time horizon for their primary financial goal and limited capacity to absorb significant losses without jeopardizing that goal. How should the advisor proceed? Option A. Politely inform the client that their stated risk tolerance is incompatible with their financial situation and recommend a very conservative investment strategy, overriding their stated preference. Option B. Immediately proceed with recommending a portfolio heavily weighted towards high-risk, aggressive growth investments, as this directly reflects the client's stated risk tolerance. Option C. Present a range of investment options without delving into the specifics of risk and suitability, allowing the client to make the final selection based on their initial statement of high-risk tolerance. Option D. Engage in a detailed discussion with the client to explore the implications of very high risk in the context of their specific financial goals, time horizon, and capacity for loss, educating them on suitable strategies that align with their stated comfort level, while also addressing the potential downsides and ensuring the recommendations are appropriate for their overall financial situation. The correct answer is D. Engage in a detailed discussion with the client to explore the implications of very high risk in the context of their specific financial goals, time horizon, and capacity for loss, educating them on suitable strategies that align with their stated comfort level, while also addressing the potential downsides and ensuring the recommendations are appropriate for their overall financial situation. Explanation. Scenario analysis. This scenario presents a common challenge in financial advisory, where a client's stated risk tolerance appears to contradict their financial situation and stated goals. The professional must navigate the potential for misinterpretation by the client, the fiduciary duty to act in the client's best interest, and the regulatory requirement to ensure suitability of recommendations. The challenge lies in balancing client autonomy with the advisor's responsibility to provide sound, appropriate guidance, especially when the client's stated preferences might lead to suboptimal or even detrimental outcomes. Correct approach analysis. The correct approach prioritizes a thorough, fact-based understanding of the client's situation before making any recommendations. This involves a detailed review of their financial capacity, time horizon, and specific objectives. It then requires a clear, educational dialogue with the client, explaining the implications of different risk levels in relation to their goals. This aligns with the fiduciary duty to act in the client's best interest, ensuring that recommendations are suitable and grounded in a comprehensive assessment, not just a superficial statement of preference. This process upholds regulatory standards that mandate suitability and a client-centric approach. Incorrect approaches analysis. One incorrect approach involves immediately deferring to the client's stated high-risk tolerance without further investigation. This fails to meet the fiduciary duty of care and the suitability requirements. It assumes the client fully understands the risks and consequences, which is often not the case. This could lead to recommendations that are not appropriate for the client's actual capacity to bear risk, potentially resulting in significant financial losses and regulatory noncompliance. Another incorrect approach is to dismiss the client's stated risk tolerance outright and impose a conservative strategy. This disrespects client autonomy and can damage the advisor-client relationship. While the advisor has a duty to guide, dictating a strategy without understanding the client's underlying motivations or comfort level can be seen as paternalistic and may not lead to the best long-term outcome if the client feels unheard or forced into a strategy they don't fully embrace. This also risks violating suitability standards by not tailoring the recommendation to the client's expressed, albeit potentially misinformed, preferences. A third incorrect approach is to proceed with a high-risk strategy based solely on the client's statement, without documenting the discussion about the risks and the client's understanding. This creates a significant compliance and liability risk. If the investment performs poorly, the advisor may be unable to demonstrate that the client was fully informed and made an independent, informed decision. Regulatory bodies often require robust documentation of client suitability assessments and discussions. Professional reasoning. Professionals should employ a structured, client-centric decision-making process. This begins with comprehensive data gathering and assessment of the client's financial situation, goals, and risk tolerance. It then involves an open and educational dialogue to ensure mutual understanding of risks, rewards, and suitability. Recommendations should be clearly articulated, justified, and documented, with a focus on the client's best interests and adherence to all applicable regulations. The process should be iterative, allowing for adjustments based on ongoing client feedback and evolving circumstances. Question 19. The efficiency study reveals that the client onboarding process is experiencing significant delays, particularly in the verification of identity documents. While the team is under pressure to increase client intake, a review of the current procedures indicates that the delays are not due to a lack of staff, but rather a complex and time-consuming manual review process for certain document types. What is the most appropriate next step for the firm to address this situation? Option A. Immediately increase the number of staff assigned to document verification to process more applications faster, regardless of the underlying procedural issues. Option B. Focus on automating the entire document verification process overnight without a thorough assessment of the risks and potential compliance gaps introduced by such a rapid, untested change. Option C. Advise clients that due to increased regulatory scrutiny, onboarding times will necessarily be longer and suggest they seek services elsewhere if speed is a priority. Option D. Implement a risk-based approach to identify which document types or client profiles require the most rigorous verification and streamline the process for low-risk categories while maintaining strict controls for high-risk ones. Correct answer is D. Implement a risk-based approach to identify which document types or client profiles require the most rigorous verification and streamline the process for low-risk categories while maintaining strict controls for high-risk ones. Explanation. The efficiency study reveals a potential bottleneck in the client onboarding process, specifically concerning the verification of customer identity documents. This scenario is professionally challenging because it directly impacts the firm's ability to serve new clients efficiently while simultaneously adhering to stringent regulatory requirements designed to prevent financial crime. Balancing speed and thoroughness in compliance is a constant tension. The firm must ensure it meets its Know Your Customer (KIC) obligations without creating undue delays that could drive away business or damage its reputation for client service. The correct approach represents best professional practice because it prioritizes a systematic, risk-based review of the identified bottleneck. This involves understanding the root cause of the delay, assessing the associated risks, both operational and regulatory, and developing targeted solutions. A risk-based approach is fundamental to effective compliance and operational management, allowing resources to be allocated where they are most needed and where the potential for harm is greatest. This aligns with regulatory expectations that firms implement robust internal controls and processes that are proportionate to the risks they face. By seeking to understand the why behind the inefficiency and proposing solutions that address the underlying issues, the firm demonstrates a commitment to both operational excellence and regulatory adherence. An incorrect approach that focuses solely on expediting document processing without understanding the underlying reasons for delays is professionally unacceptable. This could lead to a superficial fix that doesn't address the root cause, potentially increasing the risk of errors or overlooking critical compliance checks. Such an approach might also violate regulatory principles by not ensuring adequate due diligence is performed, even if it appears to speed up the process. For instance, if the delay is due to insufficient training of staff handling documents, simply pushing more documents through faster without addressing the training gap is a failure of due diligence and risk management. Another incorrect approach that involves bypassing certain verification steps to meet efficiency targets is a direct violation of KYC regulations. This exposes the firm to significant legal, financial, and reputational risks, including potential fines, sanctions, and loss of operating licenses. Regulators expect a consistent and thorough application of verification procedures, not selective adherence based on operational pressures. A third incorrect approach that involves blaming external factors without investigating internal process improvements is also professionally deficient. While external factors can contribute to delays, a responsible firm must always first examine its own processes for potential inefficiencies and areas for improvement. Failure to do so suggests a lack of proactive management and a potential disregard for regulatory obligations to maintain effective systems and controls. The professional decision-making process for similar situations should involve a structured problem-solving framework. First, clearly define the problem and its impact. Second, gather data and analyze the root causes. Third, identify potential solutions and assess their feasibility, risks, and regulatory implications. Fourth, select the most appropriate solution based on a balance of efficiency, compliance, and risk mitigation. Finally, implement the solution, monitor its effectiveness, and make adjustments as necessary. This iterative process ensures that operational improvements are made responsibly and in alignment with regulatory and ethical standards. Question 20. Consider a scenario where a client, who has previously expressed a strong aversion to speculative investments, now requests that their portfolio be heavily concentrated in a newly launched, highly volatile cryptocurrency ETF, citing a friend's anecdotal success. The advisor has reviewed the ETF's prospectus and believes it carries significant risks not adequately disclosed in the marketing materials and is potentially unsuitable for the client's stated risk profile. What is the most appropriate course of action for the advisor, adhering to U.S. federal securities laws and SEC guidelines? Option A. Proceed with the investment as requested by the client, assuming the client is making an informed decision and the advisor has no further obligation. Option B. Inform the client that the investment is highly speculative and potentially problematic, but execute the trade to maintain client satisfaction without further detailed explanation of the risks. Option C. Advise the client that the proposed investment is not suitable based on their previously established risk tolerance and the identified risks of the ETF, and offer alternative, more suitable investment options that align with their stated goals. Option D. Immediately report the client's request to the compliance department without engaging further with the client about their rationale or the investment's suitability. The correct answer is C. Advise the client that the proposed investment is not suitable based on their previously established risk tolerance and the identified risks of the ETF, and offer alternative, more suitable investment options that align with their stated goals. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's desire for a specific investment strategy and the fiduciary duty of an advisor to act in the client's best interest, adhering strictly to regulatory guidelines. The advisor must navigate the potential for misrepresentation and ensure all actions are compliant with the Securities and Exchange Commission (SEC) regulations governing investment advice. The core of the challenge lies in balancing client autonomy with the imperative of regulatory adherence and ethical conduct. The correct approach represents best professional practice because it prioritizes transparency and compliance by thoroughly investigating the client's stated investment goals and risk tolerance, and then explaining how the proposed strategy aligns or doesn't align with those factors and regulatory requirements. The advisor upholds their fiduciary duty. This involves a proactive disclosure of potential risks and limitations, ensuring the client makes an informed decision. This aligns with SEC Rule 206(4)(1), the marketing rule, which prohibits fraudulent, deceptive, or manipulative acts, including misrepresenting material facts about an investment strategy or its suitability. It also reflects the broader principles of the Investment Advisors Act of 1940, which mandates that investment advisors act with the highest fiduciary duty. An incorrect approach that involves proceeding with the client's request without adequate due diligence fails to meet the fiduciary standard. This could lead to a violation of the anti-fraud provisions of the Investment Advisors Act of 1940, as the advisor would be facilitating an investment that may not be suitable or could be misrepresented. Another incorrect approach, that of simply dismissing the client's request without a thorough explanation, could be seen as a failure to adequately serve the client's stated interests and could potentially lead to a complaint, even if the strategy itself was ultimately deemed unsuitable. This demonstrates a lack of client engagement and a failure to educate the client on the implications of their request. A third incorrect approach, that of agreeing to the strategy but omitting any discussion of the associated risks or regulatory implications, constitutes a material omission and a direct violation of the duty of full disclosure required by SEC regulations. The professional decision-making process for similar situations should involve a structured approach. First, fully understand the client's request and underlying motivations. Second, assess the request against the client's stated financial goals, risk tolerance, and investment experience. Third, consult relevant regulatory frameworks and internal compliance policies to determine the permissibility and suitability of the proposed action. Fourth, engage in open and transparent communication with the client, clearly explaining any potential conflicts, risks, limitations, and regulatory considerations. Finally, document all discussions and decisions thoroughly.